this video, I will discuss two patterns that frequently appear on the Keltner channel when using a 5-second candlestick chart. Beginners should learn these patterns because they are easier to understand than those associated with other indicators. So, stay tuned until the end if you want to understand these patterns. For this setup, a 5-second candlestick chart works well, so I have set the chart in the same way. Since the timing is better when it is double the candle duration, I have set it to 10 seconds. After that, I will add the Keltner Channel indicator and make a few small changes in its settings. And here, my setup is complete. This is a very simple setup, and now I will explain it directly using the live chart. But first of all, if you have any questions, you can ask us on Telegram. You will find the link in the description. As I mentioned at the beginning of the video, I will discuss two chart patterns. This is the first chart pattern, so let's understand it in a simple way. First, I check whether the market is near the lower line of the Keltner channel or not. If the price is near the lower line, then for the second confirmation, I look for a support area behind it. If support is also present, then half of the setup is already clear. Now, I wait for a reversal candle, which means I wait for a green candle to start forming. When the green candle starts forming, it can create a possible timing point for a 10-second position. The reason is simple. In a downtrend, the market often reacts from the lower Keltner line, moves toward the middle line, and then may continue the downtrend again. So, in this pattern, I focus on three things: the lower Keltner line, nearby support, and the green reversal candle. This is a fast chart setup, so timing and risk control are very important. So the first position has now closed, but I will stay on this same chart for a little longer. Because the market has taken support near the lower line, there is a possibility that the price may reverse toward the middle line and then continue the downtrend again. However, if the market does not show the kind of movement I analyzed, we'll switch to other pairs. Now the market has reached near the middle line, so we will wait for a bearish candle signal. Okay, here we can see a red candle that looks similar to an inverted hammer, which may indicate stronger bearish pressure. From this point, the market may start moving downward, and this creates our second chart pattern. In this pattern, we usually see that the market has been moving below the middle line for some time, as you can see in the previous price action here. Then, when the market comes back toward the middle line and starts forming red candles again, it may show that bearish pressure is returning. This type of pattern can appear many times on the chart, especially when the market is already moving in a downward direction. No matter which strategy you follow, a wrong entry can make even your best analysis useless. For this, we have uploaded detailed videos in our membership. In those videos, we have discussed the important points that should be checked before considering any setup, and we also explain how important the right entry timing is in trading. In this, we have discussed the complete process of entry analysis in depth. The link is given in the description. Now this chart falls into the first category because the market is near the lower line. There is also a support area in the previous chart, and a bullish candle has started forming. Based on these conditions, I chose to place a short-term position here. I have found another chart that falls into the first category. The analysis is the same here. The market is moving around the lower Keltner line, and there is a solid support zone in the previous price action. Now, only one confirmation is left. A green candle has not formed yet, so until we see a clear bullish candle reaction, we will not take any action. Now the green candle has formed, and our third confirmation is complete. Now I will stay on this chart for a little longer and watch which direction the market moves. This may help us see whether another clear price reaction develops on the same chart. The market has started forming red candles, so there is a possibility that price may move downward again from here. This example is quite close to the second chart pattern, but it does not fully match it. That is because the previous chart history does not clearly show the market moving below the middle line for a longer period. Also, this time the market broke above the middle line and moved almost toward the upper line. However, if I see stronger downward movement developing, I will watch the price action closely and look for a suitable short-term timing area. Here the candle has broken below the middle line again, which suggests that the market may continue the downtrend from here. Now, this chart pattern fits comfortably into the second category because many times it comes back near the middle line and then moves downward again. And the overall market movement is also in the downward direction. When the chart moves from the lower line to the middle line and then forms a red candle, it can become a possible timing area for a short-term position. In a downtrend, the market may often return near the middle line and then continue moving downward again. However, the movement is not the same every time, so the position needs to be analyzed according to the current market behavior. Now, take a look at this example and analyze which category it belongs to. Share your answer in the comments. I would like to see how many traders can identify the pattern correctly.